All right, so give us the insight. What's going to happen to the Fed? How are they going to address this transitory inflation that we have?
Okay. So there are a couple of things I think to keep in mind. First is the Fed wants to separate the bond buying from the ultimately from the rates, the short rates. And so what I think we'll see either sometime this summer or certainly by Jackson Hole is they start to talk about the bond buying being related to the tapering. And so they want to separate that that's pandemic related, but they're not going to shift their focus ultimately on the average inflation targeting, the AIT that they rolled out a year ago. They're fully committed to that. That is a more accommodative monetary policy, and it ultimately means that inflation will run hotter than in the past. Remember, the Fed's got to generate 50 basis points per year because of technological change and all the transparency that it creates. And so I do think we're going to have higher inflation, but I don't think it's going to run away the way some people do. And to that end, I think bond yields will move higher, but not to unattractive levels.
Sorry, can we be specific here, Henry? What does higher mean? Are we talking 3%, 4%? What number should we be penciling in?
Yeah, ultimately, KKR, we think rates are going to back up to about 2.5%. When you look at the past couple of recoveries, bond yields have actually gone up about 160 basis points from the bottom during the first parts of the recovery. We've only moved up about 100, and so there's actually more wiggle room that could get you north of 2. That's the bull case on why rates are going to go up. Let me give you the offset. One is transitory inflation is probably peaking right now, and the bond market, even when we got the huge CPI print last week, it started to rally. The second thing, ultimately, I believe is I think there's a huge savings is supposed to equal investment. I don't think that's the case. I think there's so much money in the system that savings ultimately will be above investment, and the yearn for yield is going to remain huge. I mean, we own over 200 companies globally. We own an insurance company, and ultimately, what central banks have done is they've taken away from savers, and that has created pent-up demand for yield. And you see that in the way that we're ultimately starting to see clients need income in their portfolios.
So there's going to be huge longer-term implications of that, because even if you get to rates at 2.25, that's still so low. So you have higher inflation, growth that's going gangbusters, more savings, and lower rates. That would imply that investors are going to have to go out the risk curve. What's the implication?
Well, I think investors are out the risk curve right now.
But even more so, maybe.
Well, ultimately, I think it's going to be this combination where what happens when that unfolds is that you'll see some of the more speculative parts of the growth market come under pressure. What's going to win is going to be cash flow and pricing power. We're in an environment right now where the input costs measured by the PPI are rising faster than the consumer price index or the output costs. That creates a margin squeeze. We saw this when China built out its fixed investment two decades ago. Companies weren't ready for that, and that's what's going to happen right now. Remember, 86% of the companies in the S&P next year are supposed to have rising margin. It's not going to happen. So there's going to be a focus on reflation investments. There's going to be a focus on pricing power. And ultimately, when you think about what we're doing across private equity and certainly in our real assets portfolio, that's where we're driving our balance sheet, and that's where we're forming capital in partnership with our limited partners.
What are the portfolio companies telling you about how that cost story is developing? Where is it coming from? Obviously, there's a mix of businesses in there, but talk me through what you're seeing in terms of input costs, what labor is doing, and how that is shaping your opinion on how this process is unfolding.
Yeah, I think labor is probably the area of the most pressure globally. Ultimately, when you look at the U.S. workforce, there are 9.5 million available jobs right now. There are about 7 million unemployed. And of that 7 million unemployed, about 40% are in the travel and leisure sector. That's only 10% of the economy. That means you have about 4 million people left for all those other job openings. That's where the tension's coming, and it's coming across everything from drivers to other parts of manufacturing, and even now you're starting to see a boom in services. So ultimately, I think that you're going to see rising labor costs. Remember, real rates and real wages didn't go up for the past decade. So it drives hugely in terms of how we think about deploying capital, which is the whole prior cycle was about betting on the slowdown in growth and getting long more and more secular growth. We still like secular growth, but what we're telling you from the KKR perch is that you're going to see a cyclical recovery. You're going to need more reflation assets, more infrastructure, more real estate, ultimately more asset-based finance. And in private equity, you're probably going to have companies with more pricing power that can do acquisitions. I saw your earlier segment on corporate carve-outs. That's a mega theme, right? That's happening globally in Korea, Japan, Europe, and it's very bullish for companies that want to get better, that ultimately can optimize their footprint, particularly around labor costs.
So let's actually get to the geographical location of where then you might go, because in some ways this strong growth is going to benefit the U.S., but then you have the emerging market angle, and if you're going to go value, you go Europe. It sounds like maybe you're not going there. So can you give me the regional breakdown?
Well, look, I mean, ultimately, we traffic more in the private markets than the public markets.
Sure.
What we're trying to do is get long areas where we're linked into rising GDP per capita. Most of the big public indexes in Europe as well as in Asia, they own multinationals and they own banks, but you've got a revolution going on with the global millennial. There's 60 to 80 million in Europe, same thing in the US, and there are 800 million global millennials in Asia. And they're all buying differently across healthcare, financial services, and that's what drives our investments. I would say, unfortunately, the human element of the pandemic, it has hit hard areas such as India, as well as Southeast Asia. But so what we saw at the beginning of the recovery is that Asia was leading us out. Right now, what we see is the US is, and you're starting to see an explosion in services. You're seeing this whole concept of nesting, where individuals want to fix up their home, they want to do more domestic travel, and they want to get reunited with their family and friends and have experiences. And so those, in my mind, will be multi-year themes, and there's capital that can be deployed behind that.
Last question, quickly, Henry. Small caps, US, what do you do with them?
Ultimately, you got to own more of them than you did in the past cycle. Small caps bottomed, and they were in a bear market in 2018. They started their bull market when the vaccines were announced. They're going to have fits and starts, but ultimately, the ones that are levered to the energy transition, that are levered to consumer spending and industrials, they're going to do well. So it's going to be a mix. It's not just value. It's not just growth. It's owning companies with good management that ultimately can improve their businesses.